Hello, I'm Chris Pedersen, and this is Stock Watch on Wednesday, the 25th of September, 2024. All information is general advice and may not be suitable for you. Always consult your financial advisor before making any investments. All questions from viewers should be sent to stockwatch@fnn.com.au. A few of my market observations. First of all, the ASX 200 is around 8,150. That's where it was last Wednesday. The CPI this morning came in at an annual rate of 2.7%. Now that sounds amazing. It is positive. Consensus was expecting 2.8%. So what we really have to do is not look at the headline, but we have to drill into the detail. As they say, devil's in the detail. China rate cut helps iron ore price, exports, and copper prices and other commodities. This is very good for Australia, and our resource sector is soaring today. Australians' personal savings rate. I added this today because it's pretty shocking. We are saving a lot less than we have historically, near zero. Residential property prices. Now, this is one of the most important charts I've put up in a long time. This shows residential property prices from 2004 to the present. If you do a compounded annualized rate of return, residential property is up around 4.85% per annum over the past 20 years. The reason this is important? If you buy equities, you would be significantly outperforming this. Average mortgage size right now in Australia, well, as expected, it just keeps creeping up. This I added just because it was interesting. U.S. drug overdose deaths. It's over 100,000 a year. This is shocking. They're talking about how they've come down. Well, you look at the chart and I wouldn't be patting myself on the back. It's coming down off of a record high and it's still at a terrible rate. This is more interesting than economics. Rallies by Donald Trump in 2016 versus 2024. If you look at his energy level in 2016, that's the orange, and then the dark red, that's this year. He's not really getting out there campaigning much. What is going on? 3 companies today. The first one, GQG Partners. The code on the ASX is GQG. It's trading at $2.68. This company is a funds management business and it has soared in value lately. Let's look at the numbers. These are Macquarie estimates. Market cap is around $8 billion. They have a price target of $3.20. Goldman Sachs is at like $3.05. Some brokers are up at $3.75 like Morgan Stanley. I felt that $3.20 was a good representation of many of the brokers and in line with what I feel expectations are reasonable at $3.20. Revenue growth for each of the next couple of years is 10.7% per annum. The earnings per share growth is around the same, a little over 10% per annum, and the dividend growth is the same, a little over 10% per annum. So then I looked at what is the shareholder equity growth? Well, that's doing better, 14% per annum. The PE on the 2026 earnings estimate of 18 cents is only 15 times. The yield on the 2026 dividend estimate of 16.8 cents is 6.3%. These are all solid numbers. They have decent growth, low PE, decent yield, has a free cash flow of 9%. Cost to income ratio of only 25%, which means our profit margin is 75%. Funds under management growth is around 9%. It has been higher, but is slowing right now, but that's okay. The payout ratio is 90%. That gives them flexibility. They can lower it if need be because they have plenty of free cash flow. GQG Partners is a global boutique asset management firm with a focus on active equity portfolios. This is as opposed to indexing. I rated a buy. Another funds management business today is Magellan Financial Group. The code on the ASX is MFG, and that's trading at $9.76. This is a 5-year chart. So they've had a lot of problems. I don't want to go into the details of what caused the problems. It's past them. Can they recover? Let's take a look at the numbers again. These estimates are from Goldman Sachs. One, the market cap for Magellan is only $1.8 billion right now. Goldman has a 12-month price target of $10. This is a little bit higher than many brokers out there. The revenue growth rate for each of the next 2 years is only 2.5% per annum. Now, this is what's pretty shocking. Their earnings growth for each of the next 2 years is negative 14%, and the dividend growth is a negative 28% per annum. This company is going backwards. The shareholder equity growth, well, that's positive 3%, but geez, I can buy government bonds and do much better than that. The PE on the 2026 earnings estimate of 73 cents is only 13 times. Well, let me tell you about that. Now, on the surface, this looks cheap. Don't let that fool you. When you have declining earnings, if I was to go out to 2027, well, then the PE would expand because earnings are even lower. The yield on the 2026 dividend estimate of 50 cents is 5%. Free cash flow is 6.7%. That's right now and looking forward next year. The cost to income ratio for Magellan is 44%. Big difference from GQG partners. The payout ratio is 70%. Magellan Financial Group Limited is an Australian-based specialist asset manager. They've had tough times. The numbers look bad. I'm reluctant to say sell, so I'm neutral. Third company today is Coles Group. I like Woolies, I like Wesfarmers. I haven't covered Coles for a while. This has been my favorite supermarket for quite some time. It's in the news a lot because the Australian government is looking at the supermarkets as an easy, convenient scapegoat for inflation. Well, they're just a very small part of it. Many inflation causes are from government policy, but picking on Woolies and Coles is a good distraction, good politics. So the code on the ASX is COL, and it's trading around $18. This is a 5-year chart. This company just goes up, down, up, down. It's a trading market. Will it go to new highs? I tend to think it has potential to finally break out of the resistance. UBS estimates, they have a price target of $21. Market cap is $25 billion right now. Revenue growth, according to UBS, for the next 2 years is only 2.5% per annum. This is a little bit on the low side and less than inflation and immigration added together. However, the past 20 years, Woolies has been doing just fine, even though their revenue growth is falling short of that matrix also. Earnings per share growth is 8% per annum, and the dividend growth is 11% per annum. Now, those numbers are looking attractive. The shareholder equity growth rate is 7%. So Coles looks pretty good other than their top line growth rate. The PE on 2026 earnings estimate of 98 cents is 18.4 times. And the yield on the dividend estimate for 2026 of 84 cents is 4.7%. It has free cash flow of 4% and a payout ratio of 85%. So as everybody would know, Coles is Australia's second largest supermarket chain, and they sell liquor and financial services on the side. Are they a scapegoat by the government right now? I think so. I rated a buy, but only a half weight. As always, if you want to learn anything more about what I covered today, send an email request to stockwatch@fnn.com.au and direct it to me, Chris Pedersen. If you have any requests for any companies you want me to cover, send an email. Hope you have a wonderful week. Thank you for your time.